back again with my boy Jay Coda. Now he has a new shirt on. I feel like Cross Country is a merch company as much as it's a lending company. Y'all got the
This is how
merch.
you know that these are done, not just back to back to back, just to front load a bunch of content and shove it out later.
That is true, which we need to do more of. Now you bring that up.
Unless we just pause the video for a minute to do a quick wardrobe change and then hop back on.
Hey, we need to bulk do these, but this one's gonna be enough. This is gonna be quick. So today we're gonna cover line of duty, the Redfin rocket takeover, and some of these realtors losing their mind on social media over this, which whatever, stupid, and then a couple market predictions. So first, I don't think there's any other, outside of our SGLI in the military where they have like a line of duty, I don't know, thing like you guys do. So explain Cross Country's line of duty and what it offers people.
Yeah, I mean, it's a great program, very unique. I think we're the only one in the industry. It's an internal program that Cross Country Mortgage created to take care of those who take care of us. It does, unfortunately, exclude military because there are other avenues for veterans and such to be able to do that. But, firemen, police officers, border patrol agents, anybody that would be considered a line of duty profession, it's a standard loan. I mean, for all things to be considered for the consumer. It's your standard Fannie Mae, Freddie Mac, FHA loan. No higher interest rate for the program. It's a standard rate. No additional cost for the program. Essentially what it does is if something were to happen and you were to unfortunately die in the line of duty, Cross Country Mortgage would pay off your mortgage for your family within a week up to $525,000. Essentially taking care of your family. Where this kind of came about was an experience that somebody through Cross Country had, a friend of theirs, and the insurance that they had on the home drug out, I believe, over 12 months. You've got somebody that is not only grieving in your family, but having to manage the expenses of somebody tragically, being lost, emotions, and then you're trying to manage and upkeep household expenses month over month. And what if they were the breadwinner of the family? You could either have your credit destroyed because these insurance companies, they're not in a rush, right? We've all dealt with insurance, whether it's auto, home, health. They're just in no rush whatsoever. Like it's almost, it should be criminal, so to say, but it's not. I mean, they're just going to take their time, and when they get to you, they'll get to you. So you've got to deal with everything in between that time. So, what we're going to do is we're going to take care of that within a week.
So does this apply, like, say, when they retire too, and they're still like they're receiving pension, or does it have to be like
it would have to be
during
in the line of duty that you're in the line of duty? Now, I mean, you don't necessarily have to be like, again, these are all tragic things that we'd be speaking about happening, right? Of course, but it could be somebody that works inside of a police station and maybe something happens inside of the building, right? You don't have to be somebody out there on the street, but if you work for one of those professions and something were to happen and you pass in the line of duty, then this would apply.
So that's what I'm trying to say. So like maybe line of duty is like military. Line of duty is like if you're in an active status, whatever. But your guys' line of duty, even if I'm on my off day and I say I'm a police officer and I, die on my off day doing whatever, does this still count, or does it have to be while I'm actually on the clock?
While you're actually actively, at work.
Okay. So on top of that, does it go in conjunction with insurance? So say, they have life insurance plus that. Is it two separate things, or do they kind of play off each other?
So, yeah, I mean, whatever they have outside of the mortgage itself, right? Because our concern is only, the mortgage itself. And essentially, again, without it being spelled out, but my assumption is just that Cross Country Mortgage is going to buy out an insurance policy on that.
Yeah.
And we're going to cover that cost up front, and then more than likely, go and chase down the insurance policy in our own time, because we probably have time for it, right?
Yeah, which is amazing, right? Like it's like that thing back in the day, when the employers would get like life insurance policies on their employees just in case.
Yeah,
smart, because it helps Cross Country get their money back, but it also helps the family just by taking that little extra bit of step to get more insurance that they don't even see, they don't even pay for. Smart on both ends.
Yeah, no, just take that burden and their weight off of them, in a very difficult, like I said, and tragic time. There's more important things when those moments occur than your first thought being
how to make the mortgage. Yeah,
right. But it's going to become a reality, and you eventually have to, because life does continue. Unfortunately, you don't get all the time in the world, but to have to deal with those things after the fact. So
some of them,
it's just one of those things. Like I said, it's to take care of those who take care of us. I mean, I don't know any reason or can think of no reason why if somebody's out there shopping and you're in one of these positions, why this loan would not be the one that you go with versus the one at bank XYZ. Because
Yeah.
it's the same loan, same rates. Again, rates aren't elevated. There's no additional closing costs for this. We're not passing any additional cost off to the consumer. It's just we're going to add this to it, and that's at our cost.
Is it
Not there.
elected or is it just automatic? They're police, fire, first responder, whatever.
Well,
Is it
like we discussed it with them because we have to select it in our system as that being the option that
yeah.
we're going with. But we bring it up to the client. Some I don't know why a client would say no. Haven't had one yet. But
Yeah.
they can of course choose to go with a traditional one and not have that option.
Well, yeah, that doesn't make sense at all.
Yeah,
That's
I can't think of a world where somebody would say no. Don't check. Don't worry about my
yeah,
family. I got this.
yeah, yeah. That's crazy.
Each his own, but it's like I said,
That's
it's
a
just
dope.
a unique program. Just kind of
Yeah,
speaks to our ownership is looking to do in taking care of people, not only just helping put people in homes, but doing the right thing by other people. And it's always something that feels good to be at a company that does things like this to look out for those. That
yeah, it's dope.
again, I don't mean to sound corny or repetitive, but those who look out for
Corny.
us,
Motivated,
So
corny and motivated. But
yeah,
do you think there's any
true.
plans on getting the rest of the village people in the YMCA, aka us, in that as well, or are you just like
I don't
military?
know. I haven't seen any memos on it. I know it's been asked in the trainings and such, but I'm not sure if they're going to add anything from the military side of things to it eventually. It'd be nice. It'd be nice to see anything that you can do extra to ever help people in the military, right? Because they all put their lives on the line. So
We have SGLI and all that stuff, which is a 400 something, whatever. But it's just a joke, poking in, telling your CEO what's up. No, I'm just kidding. But speaking of CEO,
I'm sure Ron's tracking and following the Insta that you
hey,
got
you
there.
never know. Hey, man, you never know. Speaking of CEOs doing crazy shit, Rocket Mortgage purchased Redfin. I think it's like 1.75 billion with a
1.75
B.
billion. Yeah, Rocket companies.
B.
So like the umbrella of Rocket Mortgage and everything.
So Rocket started, didn't they take over? What was that one we used to do our taxes on? Like you did your taxes yourself. They took over that company. I forgot what it was called before Rocket took it over, but it was where you filled out your own taxes. Yes, they took over that. They took over now mortgages. They're just trying to be the, I don't know, Google of all things finance.
Well, I mean, they've announced it themselves that that they are a marketing company. It's funny. I don't know if I'm allowed to share a screen on this. Can I share something with you? Just to give you
like Nike, man, just do it. I don't know.
So today, well-qualified borrower with today's rates, right, is going to get about 6.875 on a conventional loan, 6.95. Now, again, this is not everybody that's buying with a conventional loan. There's a lot of what they call LLPAs, loan level pricing adjustments, that go into rates for each individual if it is not an FHA or VA loan, but well-qualified borrowers. So if you look at what Rocket is advertising today, because everybody's, again, very well aware of them, you can see today their rates 6.99%.
Mm-hmm.
Right underneath it.
Points. And that's based off of what loan?
That's a 30-year fixed mortgage.
Yeah.
So again,
you see that quoting price, that 5,000 is based off what home. Click the little guess button over there.
Oh yeah, I mean it's based on a loan amount. It just tells you that it's what points are. So it would be based on something like around a $500,000 loan.
Yeah.
Just to kind of give you perspective on cross country's rates. That rate's available with no points, and yes, we are the number one retail mortgage lender in the United States. Rocket is one of the larger wholesale mortgage lenders out there. If not the largest, it might be UWM, but every bank's going to be different, but they do a great job. They are a household name, so
that, and they do I mean, like you said, they're great at marketing, but realtors are, I mean, you're not huge, not big on social media a lot, but a bunch of these realtors trying to do talking head, talking about how, oh my God, one-stop shop. And, it's honestly, in San Diego, it's not going to change much because we can't even use Rocket Mortgage or any, conventional bank because they don't do small stuff, right? I think people need to realize, like, when they hire you, Yes, you work under cross country, but you don't get paid. You don't get anything until your customer is satisfied. Whereas you work at Rocket or Bank of America, Navy Fed, whatever, those dudes are getting paid regardless if your house closes or not. They don't care
Yeah.
about you
Well, I mean,
at all.
real relationships in the industry, locally and in the community, where people know who you are. They know the type of work that you do. It's a relationship business, and not to say that, hey,
Yeah.
listen, consumers should shop for a mortgage. You should get to the point where you feel comfortable with somebody, but it's not always rate. You spend a lot of money on marketing. My assumption with that goes, who's paying for that overhead,
Exactly. And
right?
let's dumb
I
it
mean,
down. Let's
trickles
let's dumb it
down,
down real quick.
it's always going to trickle down, right?
Yeah, but
Cost
let's
always
dumb it
does.
down. Dumb it down just a little bit. So what
You
we talked
pay
about in
for
previous, yes.
it. You,
So
the
previous
consumer.
episodes, all lenders, every bank is dealing with essentially the same pot of money. And they're all competing, just like the real estate market, they're all competing on the loan market. So now, you have this big conglomerate who reaches more people than anybody. So they're trying to pass on that marketing expense through you having to pay extra points. They're taking that risk because they know they touch and have so many impressions and all this marketing stuff that they can charge a little bit more and still make a return. Whereas with most businesses that don't do a lot of marketing, like cross country, you guys are all pretty referral based. The whole thing is
Yeah,
referral based business. That you guys pass on that savings to the consumer. So instead of having to
sure.
pay $5,000 get that rate for $500,000 home, they get it. So I think
Yeah,
that's why I'm trying to wrap in people's minds, like this is why, like mortgage market rates and home prices they're two markets. They go in their
yeah.
own world.
Well,
Doesn't
every
make any
bank's going to
sense.
have expense. Every bank's going to have overhead, and don't allow it to surprise you. Your loan officer's going to make money,
Yep.
just like your
And they
realtor will.
Pete.
And they
Yep.
work. The good ones work very hard to be able to earn that money, just like anybody else does in any kind of job, right?
Yep.
It just comes down to, like, where is that cost passed off? Because you can pass it off on, consumers are always going to carry some of that burden, right? Ultimately.
Yep.
But is that
It's like the
money
tariffs.
invested in infrastructure, right? Underwriting processes, programs, products. Is it invested in capturing you as a consumer to come to their business?
Yeah, that's
Um,
the same thing on the real estate side, right? Like we talked about it before. People have to realize that this is a business and they need to run it as such, right? When you're paying 40% of your revenue to Zillow just to get that phone call from the potential client, you're taking away so much of your revenue that you can't pass on any savings to your clients because you already spent it all. And when you
yeah,
do, I know there's a happy medium balance, whatever. And this, I don't want to get too in deep into like the business side of people, their eyes glaze over. But when most of those realtors out there where they say I've closed so much business and that is just gross commission. That is not after expenses or anything like that. I was doing the
yeah,
math with one of my realtor friends, which I don't want to name. One of their transactions is equal to almost four of mine because they do the Zillow thing. So they have Zillow expense, they have their brokerage, they have their team lead, they have all these expenses. So kind of like what we're saying about lending, when you work with somebody that's so knee deep in expenses like Rocket Mortgage and where they're trying to, it's Redfin too, they're trying to cut so many costs to kind of pinch that penny. There's not enough lot of room for you to pass on that savings to the consumer, kind of like
sure.
tariffs.
On the
Kind of like
flip side of
tariffs.
that coin is discount services. Lenders, realtors get you discount service. You're going to
Yeah.
pay for what you get. Because there is more value to whether your realtor makes 3% or 2.5%. There is more value to the lender you work with, whether it's 7.125 or 6.9. Everybody focuses on the number. That's the elephant in the room, right? Rates are elevated, yes. But I mean, I don't care what market you're in, who is going to get you the home? Do
Hmm.
you have the right realtor to find you the home? Do you have the right realtor to negotiate the best terms for your purchase? Do you have the lender that can execute that with no unwanted surprises and get you to the finish line? 19% of all transactions last year fell apart in contract because of lending
Oh yeah.
issues.
Yeah.
74% of all licensed realtors did not sell a single home. Those are facts. That's not made up. Anybody that watches this, go check it out online. It's, interesting to see that. But like the cheesy line that everyone throws out, good and bad realtors alike and lenders, who you work with matters. but it truly does
Cliche.
matter. I mean, so penny pinching, for a 0.5% savings on the commission of your realtor, or the 1/8% that an online broker can give you that doesn't know anybody here, is just going to sit behind a desk, and push paper, and not really, and they're going to give you the 30-year fixed option with the buy down because they assume that that's what you want, but they have no idea what your true goals are, nor how to look at the financial structure of how to put you in the best position as a household financially today and down the road, depending upon what your goals are. I mean, they're order takers,
Yep.
right?
And that's the thing though, too, is especially with the new buyer's representation agreement and all that stuff coming out, the real estate model is going to have to change, right? You have these team leads and people that overcharge their realtors. Like, I don't have a team. I don't charge. I don't pay no one. So my brokerage, and that's at a cap. Because now you're competing, right? If I'm submitting an offer to you and I'm requesting 3% commission because I have to, because I have all these expenses just to survive. But then you have someone that like me comes in and I can offer 2% buyer's commission and still make more than you because I have no expenses. Not only does that make my client's offer more attractive, it also puts you out of business because you don't run your business lean enough to be able to have that leverage to be able to survive and adjust costs. Because the thing is, it's coming, right? Now it's a negotiable thing, right? No, sellers, they see, it's just another lever for them to analyze offers, like we did with Ernie's home. Like if one realtor says 3%, the other one says 2%, that person just gained a whole percent on their home, right? And that's the $700,000, $7,000 they just made. So I think, especially on the real estate side, I mean, lenders, you guys have been doing this since, 2008. Now we got to start running it like a business. And if not, you're going to get put out. Realtors and sellers are getting smarter. They understand like the numbers now. They can see it, like any good list. Like we broke it down for like Barney style. Like, hey, if you accept this offer at this price, it equals you taking home this after expenses. If you take this one because the expense of the realtor commission is less, you're going to make more on this one with even a lesser offer. So I think, like I said, I'm going to beat it as an MBA. I'm going to beat a dead horse 1,000 times. Running it like a business, because that's what it is, will dictate your success or failure. Regardless if Rocket Mortgage, Redfin, whatever, Northrop Grumman buys in real estate. At the end of the day, if you run your business, small businesses, which what we are, efficiently, no one gives a shit what your brokerage is. No one looks, they don't even know what brokers I work for. No one cares that you work across country. No one cares. They care about the person. And how is Jason? How is Ian? What is his SOP? How is he going to benefit? What value does he provide? Not the brokerage, not the
it always makes me kind of chuckle, like, everybody does and reads, reviews on Amazon and reviews everywhere else. But when it comes to like lending in real estate, yes, you can find reviews online, but like what most people will go to is, what do you charge? What is your interest rate? Yep. Like not how many families did you help last year, right? Mm-mm. Which should be kind of the mark. Like the ones in a market like this that are able to close 10, 12 plus buy sides a year, or list sides. I mean, or from a lending, I mean, whatever you want to, put that benchmark at. But I mean, I would think that would be the first and foremost thing that you'd want to look at is, can they close my loan? Can they negotiate my purchase? But looking at it as a buyer, know who you're working with. Most important thing is not that you got a 6.5% rate. If you can't win the deal, the rate is irrelevant, right?
Yeah. But that also goes on the realtor too. We talk about this all the time. Bad interactions between the lender and the client is 100% the realtor's fault, because that means they're not educating them. First, this is a 30-year investment. This is not, you're not day trading like, oh, can I get a 0.12% difference and change is going to change my life? It's like, dude, chill out. Worst case scenario, the market stays the same and interest rates drop, or interest rates stay the same and home prices stay the same. In 10 years, you can refinance just based on your principal and drop your payment. So it's a long-term investment. And I feel like a lot of these realtors don't understand numbers or math. Because back in the day when I came up, you had to understand lending and you had to understand the numbers to do this. Now they're like, numbers, talk to a lender. So basically shotgunning you to answer whatever jacked up questions that these unrealistic, because it's emotional. And we've talked about this 1,000 times. Like when you're buying,
Yeah.
emotions run high, common sense and logic run low. So having that smooth transition to make sure like, hey, this is the 30,000 foot view. You want even more in depth, talk to Jason and he'll tell you exactly what you're at,
Well,
where you're going to be. If this makes sense, that makes sense, whatever.
well, yeah, and give you, like I said, I mentioned, give you options. Like there's different
Options.
ways to create financial flexibility if you're a lender. But again, what most lenders do is just cut and paste a vanilla loan and shove it down your throat to assume that this is what you want and it's just rate based. We've got the lowest rate. We got the lowest rate.
Pre-approval.
Like lowest rate is great. Everybody's rates are going to be competitive. Can you shop continuously again and again for a lower rate? You're probably going to find it. Are you going to get the home that you want? How are they going to work on your behalf? Are they available, when you need to be able to speak to them, not during their banker's hours? We do this all the time. I mean, here's an example of one consultation. We probably went through 5 different variations of this to get down to 4 different options, 4 different ways to structure a loan. Within that, we're going through not just rate, different ways to create savings and payment, but we're going through what is your net monthly payment? What is your true expense of owning this home after you take into account the tax benefit? After you take into account your principal paid? What's the principal paid versus rent paid? I mean, like truly doing an in-depth review of what it looks like to own a home, the benefits, different ways to structure it, right and wrong. Because you should know, hey, great, here's an option, but here's why not that option. So you understand that's not the best way to do this now. Here's a better way to do that. Or, you and I have had this conversation and had videos on it. Like 20% down is the old math of thinking that this is what I need to do to buy a home. We have in-house programs for 15% down with no mortgage insurance and the same rates as a Fannie Mae loan with 20% down, but no mortgage insurance. It's our cross-country mortgage buy-buy PMI program. PMI is not that expensive, even if you don't qualify for that one. Save the money, maybe pay down debt, create more financial flexibility. But again, you're not going to get that from somebody that is an order taker or is just at an online bank handling this stuff. Not that there aren't other good lenders out there. I'm not assuming I'm the only one. There's a lot of great lenders out there. Most of them happen to just be at Cross Country Mortgage. But
plug.
There's a plug for you. But I mean, there's a right way to do things, and I don't think the consumer focuses on the right value of
and I think
teaming
another
with
one.
realtor
This is
or the mortgage loan officer when they're shopping for one.
This is not knee deep in the bean counting weeds, but I always tell people, anytime you get a quick pre-approval, 1 day pre-approval, it's not worth the paper it's printed on. They looked at your debt to income. They didn't do anything. Like this whole, this whole 24-hour pre-approval. I don't know why people fall for it.
The best is my loan officer pre-approved me, because we should stop and rewind to talk about what a loan officer's job is, and it is not to underwrite your loan. So anybody saying my loan officer qualified me, no. Be cautious with that, because
100%.
You can have very good technical loan officers. I like to think a very good technical loan officer. I understand guidelines. I know our programs. I know our products. I know different ways to structure and find value in loans that other people don't. But my job is not to underwrite a file. There are other things that are involved in that I just simply, that's not me. That's not my role. We pay people for that role on my team. But what most banks do.
Third grade. Project manager. There you go. Project manager. So the realtor is the coach of the team. The lender is the quarterback. He's not just there to score touchdowns. He has to run the offense, read the defense, strategize with the coach how to make it forward. You're not just running the ball every time, because that's the running back's job. And I think people need to understand that there's whole groups of people, like they'll see my face a ton. They'll see you a couple times, but there's a whole group of people that go into getting you through that door. Yeah. Fighting with underwriters, making sure it works. I just think that's where people have to understand, like, is 1 day underwriting the loan. If a loan officer is telling you, like you said, I'm pre-approving you, it's inaccurate. That is just a blank piece of paper with words on it.
You know what I mean? And hey, maybe if you don't have enough business as a loan officer to afford an underwriter on your team or a pre-approval specialist, if you want to call them that, then yeah, I hope you're really good at doing that because somebody needs to, right? But I mean, for most banks, the process is to go into underwriting once you're in contract, right?
Which
After
is
the fact. And this is
so
where the fun begins because this is where you find out, and maybe you still hold your approval, right? Like, I mean,
maybe
nobody
you
wishes
don't.
that a deal falls apart for anybody, right? Because there's a lot of hardworking people involved, and the client, like even if somebody goes with a different bank, I don't no ill will. I hope they get their home. But even if you're not qualified, they could deny you. But maybe it's just a fundamental change to the financing once you go into underwriting to where, well, that doesn't work for you now.
Oh yeah,
Right? I mean,
and
maybe,
that's the
and
and
you
the
wouldn't have gone down
experience.
this path and invested money in inspections, appraisal, which that's going to run you about $1,500, probably $1,200 to $1,500 right there in inspections.
And then you have to bail
And
out.
then you have your EMD, which is your money that's on the line. You could lose a lot of money on an emotional, process, on a financial transaction that a good loan officer will protect you from, and a good realtor will protect you from having
Third
the
grade,
opportunity to either lose that money or get your home.
third grade, third grade. When and because Jason doesn't work with other lenders, and I've had the unpleasurable experience of working with other ones. It is so sometimes the lenders get myopic, right? Like their whole fixation is on the lending side. But there's so much more stuff that goes on. The way we do it, you do it, is you get all that, butt pain, administrative nonsense out of the way, fight with the underwriter, get it all done. And that's why 90% of the time, 99%, we only have a loan contingency. And what that means for you as the buyer is that's one less thing. That piece of paper means money. You already have the closing conditions. You already have all the stuff most time worked out. Now you can focus on the inspection and all the other emotions, packing up your house and figure out move dates and all the stuff that is going on outside of, oh, can you find a lease agreement for a previous house, or last minute, talk to your CPA from 10 years ago? Like, no one wants to do that when they're already buying the most expensive thing in their life.
And inherently, like, buying a home's exciting and it's a great thing to do, but inherently there are stresses involved in buying a home.
And doing it
So
right, it leaves a lot of that
prepare
stress. But a lot of
yourself.
lenders don't do that pre-underwriting thing like you do. They want to save it when they're in escrow. And once again, from the strategic side of it, we can close way faster because all that nonsense out. The loan contingency for people who have never bought a home before is usually the longest part of the damn everything else we knock out quick. Outside of that, we're just waiting on the appraiser to get in and get out. The home inspection is quick. Curtis goes in there and knocks it out, within the first week, not even the first couple of days. Usually, and this is my experience I had with another lender, they wait. So now everything is contingent on the lender and waiting, and then you don't even know. And it's just so much more stressful and less streamlined. And as a Lean Six Sigma guy, I want to streamline quick. Boom,
You could
done.
be
All
working
right.
with the lender, as we both know, for over a year and them still not be able to close your loan when it came time to buy.
Well,
So,
the
I
thing
mean,
is, they don't invest the money in it, right? Like you invest, like I invest. Like when someone buys a home, I buy their home inspection just because I want them to have it. Is that's easy. You guys make sure they get pre-underwritten with an in-house underwriter. Some people don't invest that capital into that part of their business because I don't know what they're doing with it. Maybe they're pinching pennies or being lazy, but that makes you a better lender. That you can provide better advice. You can help somebody, but they don't want to do
I
it.
mean, BMWs, Range Rovers, name the car that's a high-end luxury car. They spend more money on better materials, better safety, more testing to give you a better experience and a safer vehicle for you and your family.
So you don't look stupid.
It's
Like
still a
at the end of the
car.
day,
It still
we're
has four
advisors.
wheels. It's got one axle, one engine. It's got brakes and gas pedal, the same as the $15,000 car that you can buy. And there's nothing wrong with $15,000 cars. But I mean, there's a difference between Nordstrom's and Macy's. There's a
Yep.
difference between a BMW and a Honda Sonata. I mean, there's a difference. Not that either or is bad, but you pay for what you get at
But
the
also
end
it
of the
makes you
day.
look better, especially in this world where, it's a service, it's an intangible service. So your product, like the inline, the interiors of a car, a luxury car, whatever, is your advice. And if you don't have, if, you're shooting in the dark, if you're not doing like as a realtor, you have to be a data expert, understanding. For example, I could tell you year over year, every single family home, single families, how much they went up versus 2023, 2024, month over month, all that kind of stuff. And the same thing goes for lenders. But when you don't do that extra step in getting it pre-underwritten, you're shooting in the dark. Yeah, I think you can get a close, but I don't know yet. Like, stop it.
Well, yeah, or we'll find out when everything else comes in. I mean, there's a lot of that.
FAFO.
Yeah.
They're bashing on your non-competitive lenders. What is your market predictions quickly? Because your boy has to change his tires. Market prediction going up, let's say next 6 months or going into the summer, whatever.
Personally, I think that at this point in time, I mean, there's a lot of uncertainty in the market, kind of what we're seeing right now. We don't know how some of the new installed
tariffs,
well, not just tariffs, but just anything with the new administration or and this could be any administration, just not to be political. I mean, any administration is going to have a different way of doing things. And the market's going to sit back and either already have an idea of what they believe to be true, or it's kind of, we need to wait and see what happens with this. And the market's going to react accordingly. Personal belief is I think that the Fed is probably going to cut next sometime around June, July, would be my guess. I don't think the rates necessarily are going to be the rates will improve. They're not directly tied to the Fed rate because we've talked about that before. I think the current Treasury Secretary Bassett does have the right mindset because his focus is on the 10-year Treasury. And what can we do to lower that? That will free up mortgage rates for us. And as we get the spread, which is the difference between the 10-year Treasury and the 30-year mortgage rates, back in line with historical norms, right now it's right around 2.25 to 2.5 spread. Historically, that spread is somewhere around 1.75. So if the 10-year Treasury today is at 4.2%, realistically, rates should be sub 6%. They should. And it's been out of whack like this for the last 3 years. So it won't take just the Fed Reserve alone to drop the Fed rate for mortgage rates to come back down. If that 10-year Treasury gets in line and those spreads decrease, we're going to see mortgage rates get better as well. I think by the end of the year, we're going to be better off than where we are now. I mean, that's a very broad statement. We'll see. I mean, I have personal opinions. I mean, things could break. We could fall into a recession. Rates could drop. Before
things just going to be hard, man.
Break before they get built back up, right? If that's the current administration's plan is to, take the mold that exists and create a different mold. Well, you've got to break the original one first, right? So maybe that, again, I'm not an economist. Maybe we go into a recession. Unfortunately, things that are bad for our economy, like recessions, are great for our industry. It's just a matter of fact. So if we hit a recession, that could be really, really good for mortgage rates. I don't know if that'll happen. I think personally, if I'm to be conservative, I think rates end up somewhere for a 30-year mortgage around 6.5%, maybe get near 6% by the end of the year, if things go right now.
Yeah.
Hopefully we get better.
You keyed on two things, right? And as someone that had to study economics, the two things that dictate a market more than anything, more than whatever, inflation, anything like that, is certainty and uncertainty. When someone's confident in how the market's going to play, they can anticipate it, and it's very easy to predict, people start buying. So if the interest rates, mortgage rates, stayed, say it was at 7, whatever, pick a number, and it stayed consistent, that would change, the way the real estate market, because you can anticipate it. But this being erratic and uncertain, and the effect of tariffs that's going to have on inflation, which is going to hurt the Fed, all this uncertainty and chaos and not being able to predict or reasonably estimate what's going to happen causes people to feel uncertain, which makes them afraid to make the largest investment or buy anything, to be honest. But it affects people wanting to buy because you can't anticipate. So I'm a little bit more conservative than you. I think that the inflation is going to go up because it's the natural order when the cost is passed on with tariffs to the consumers. And that means everything, that Toyota, that Lexus, if it was made in China, which is not, but Now it's 25% more expensive. And that doesn't mean China's paying 25%. That means you're paying 25%.
Sure.
So seeing how this shakes out and if it holds on, I think that'll be a huge thing, not just for real estate, but for people, buying the whole egg phenomenon. Man, what? I get it, the bird flu or all that shit, but eggs going up
I
in
mean, we're
cost.
68, 69 days in, something like that. I mean, I don't think the market knows what to do with what we have right now. I
Chaos.
think there are fears, and when I say the market, I mean investors, because they're they're gonna flee for safety into more long term investments that are safer havens,
Mhm.
right? Which would be good for us in our industry. But again, right now, I just think everyone's trying to find out where their solid ground is
Yeah.
with what, again, the new administration is trying to do, and hopefully it all works out for everybody, for average Americans, for the real estate market, for home buyers, because I mean, I think everybody is ready for some relief from what we've had the past 3 years, and I'm just talking about from an expense standpoint. You know
Yeah.
what I mean?
But also
Groceries.
stabilizing, right? It's
Well,
normalizing.
yeah, like it's been erratic. I mean, it was been erratic. It's probably going to be a bit more erratic for a little while. Who knows? There's a lot of, like I said, it's yin and yang from previous administration to current administration. There's a lot of changes going on. Things were expensive already. Do they get more expensive? Possibly.
And that's the thing
Is there
too.
a
I
path
think
to see something come down? I certainly hope so. For all Americans.
it's tough too. People always go back like, oh, I need rates to drop down to 2.75%. It's like that wasn't good either, man. Like having
No,
it, we just need
it
consistency. That people needs to be
sure.
consistent and have an idea of what's the bandwidth for rates. Say they go up to 5.5 to 4, between 5.5, 4.5. It's consistent. It's going to be, because even when it was 3% rates, people were spending way more than they had to on homes, and that wasn't I was advising some clients the other day, like, I bought a home and sold a home in 2 years in Bonita, right? And I made like 160 grand. That's unrealistic. That's not sustainable. You know what I mean? Like, was it cool at the time? Yeah, but it doesn't translate the way people think it does, right? Because that home that you want to buy also went up by that ridiculous amount. And
Yeah.
I guess San Diego's kind of different than national news, but I'm actually doing a video on this. But we're going through kind of a county-wide gentrification, because there's nowhere outside of like really far east that you can buy something affordable. Like the home price, like perfect example, the single family home median home price is 1 million, almost 1,075,000 bucks, which is up almost 6% year over year. Right? It's a little bit less than it was from 23 to 24 in February to February, which is 12.9. But that's ridiculous. Like your average income only increased by 3%. So homes, even with these interest rates, are still doubling how much you're making at your job, which is,
Yeah.
granted, it's different across the nation, but here it's ridiculous.
Sure. Yeah, it is. I mean, and nobody's going backwards. I mean, places are slowing down, right? I
Yep.
mean, we went from being on the
Normalizing.
Autobahn to being stuck in 5 o'clock traffic,
Yep.
right? Possibly like maybe the worst 5 o'clock traffic. But to your point, saying things weren't great when rates were 2.875, 3% or whatever, you can't sustain that
Mm-hmm.
growth of what the homes were selling for and call that healthy. Like you
Hyperinflation.
can't. Like, I mean, things slowing down because of rates has actually been probably a good thing to
100%.
correct a little bit
Yeah,
in the market.
100%.
But again, you still have 12% growth 2 years ago, 6% year over year growth last year. So it tells you the resiliency of buyers, but yeah, you're going to move the needle on where people are moving to next with money and what becomes the new norm in those less affluent areas that people are living in, right? I mean, like you said, gentrification. I mean, the people with money are right on the edge of having money, but can't buy the wealthy properties that the wealthy buyers are buying. They're going to move into neighborhoods, and then you're going to start to see that neighborhood start to grow and flourish a little bit more. And then that's going to
Exponentially.
change the landscape of that community right there. But that's the natural order of things, I feel, in most places.
I just feel like with us, because San Diego's different. I talk to realtors all over about marketing and all that, is that we have such a huge influence from outside, right? Because it's so expensive to buy here, right? This median sales price is $1 million, but we have a home that's for sale for $100 million in La Jolla. It's like, come on, man. So what's happening is the middle class people that, or lower middle, whatever, bought a home in Chula Vista 20 years ago for 200,000. That home's worth 2 million. They sell it, dip out to Texas, Florida, somewhere, some other third world state. But you can buy, but they can buy an entire city block with the money they made from their median, average home. But in the
Yeah.
inverse, we're taking all the people that can afford a $15 million home, a $2 million starter home. And what's causing it is this exacerbated, gentrification like cross county. And
Mhm.
you have to go inland east to Alpine, Brigglesy,
I mean,
Bonzel to find a deal because La
you
Mesa
don't
is getting
already own,
expensive.
if you
Oh
don't
yeah,
already own in San Diego and you're working, a minimum wage job, the opportunity to buy is probably not there.
exactly.
Which is sad to say,
Buy that starter
because
home.
there's generations of families that are from San Diego, grew up there, et cetera, and they're going to be priced out,
Oh, 100%.
unfortunately.
My family's from Del Mar.
So,
They could never buy the house that we grew up in. Are you crazy?
yeah,
Like
thankfully you've
14
got.
million.
I mean, Texas is close to affordable. Arizona, along those same lines. Nevada, along those same. So you might see them starting to branch out and moves to those neighboring states to find relief, or maybe I'm not saying north to San Francisco, but maybe north to Riverside, Oceanside. I mean, I think Temecula's already kind of seen their influx already, but you're going to see northern movement as well, not
It's like a
just
big
east
push.
and south. I mean, IB already jumped 3, 4, 5 years ago, and that was the last
Oceanside.
beach place, right? Like in southern, in the
Oceanside's
southern.
blown up. Man,
Yeah,
you got to think of it. Look, if you look at our dynamic, right, San Diego, you got the mountains to the east, you got Mexican border, you got obviously a huge body of water, the Pacific Ocean to the west, and then you have all that land above is Camp Pendleton. So no homes are ever going to go there. So we're boxed in. There's not a lot of places for anybody to even build homes. So what they're doing is they're moving up, right? And everything around San Diego is blowing up. Temecula, Marietta, Menifee, all of it, because people would rather drive an hour and a half a day both ways than it is to be able to buy a home than it is here. So I always tell them, and I know you double tap it too. I just want to make sure people hear it. Buy that starter home. I don't care if it's a studio. I don't care if it's a 1-bedroom, trash, whatever. Just buy something and live in it for as long as you need to, and then use that to leverage up. Because otherwise, you're never going to make up that difference in the home prices. And
you won't.
And we had our inventory increased by almost 28% for single family homes and almost 48% for condos and townhomes. And still, there was no price help. Like there's no relief in the pricing here.
Here's the deal. More inventory doesn't mean that there aren't more buyers in the market. Now, some of them might be moving out of state, but most of them need a replacement home. And if they're staying in Southern California, they're entering into the pool as a buyer.
They're on the benches,
so it's,
bench warmers.
It's not 100% offsetting, but there's not much of an offset to home listed to buyer entering market. I mean, I don't know what percentage of sellers are leaving San Diego for other markets, but it'd be interesting to see, to have an idea of what's really that attrition rate of people falling out of San Diego altogether, even when they sell, even if they can afford to buy, but just choosing to still leave.
Well, it goes back to the economic principle of supply and demand, right? So people are like, oh, we have an inventory problem. We have an inventory problem. Okay, we do because we're boxed in, right? But inventory went up by 47% for condos and 28% for single family homes. And still we didn't see a price reduction. So at what level does inventory need to rise in order for us to see some, price reductions or price easing? And if it's had to be a 50% increase and still didn't see anything, that just shows that there's so many people waiting to come to buy a home. And I'll reiterate again, foot stomp, whatever it takes to write this down. If anybody listens to anything, just buy a home. It doesn't matter, where it's at. If it's, under a freaking bridge, don't care. Buy a home. That's it. And you're going to ride the wave with everybody else, because otherwise you're going to look back.
I think that magic number is like 5.5%, 6%, and you start to see the market tick up substantially when you see anything sub 6% come into play.
Oh, rates? Yeah, that's what I'm saying. Like even with these rates,
like we talk about floodgates opening up.
Yeah,
I think when you get sub 6% rates available again, which I mean, Listen, we were only for a couple days, but September 16th of last year,
Yeah, what'd you give me? You got me
5.5,
5.75.
5.75 on government loans,
Yeah.
low sixes on conventional. I mean, that was a cause of the unemployment rate jumping up to 4.3% unexpectedly.
Yeah.
Well, what do we expect to happen here in the near future with mass layoffs? I wouldn't expect the unemployment rate to be going down, quite frankly. And like I said, some things might just break before for their plan to get fixed, right? Whether right or wrong, you disagree with it or not, the path seems to at least lend towards, there are going to be more people entering the labor market.
Yeah, so that's in September. Because that's when
There's not a lot of
that's when that whole firing thing, mass firing of government employees, it's September. They give them like a way out, like, hey, don't
but
get out in September. But regardless, I think too is people right now and for the next 3 months going into summer, buyers are being more selective because there's it's more expensive to buy the home that they wanted for the last 2 years. And I think sellers need to understand that. And as much as I hate saying it, and I tell my clients this too, Zillow, Homes, all those estimates are not accurate, but people look at it. And if you price your home above where the Zestimate is, people are naturally gonna be like, overpriced. I'll wait for them to drop it. That's why the days on market went up a bunch, even for us going to the spring. Because people are being more selective. Like, I don't know. I don't know. I'm scared, uncertain. Don't be uncertain. Pull the trigger.
Yeah. I mean, at the end of the day, I think it's kind of been true for a while now is if you can afford it, buy a home now because rates may come down, but it's not going to get more affordable as far as the cost of your home that you're going to get into. If you can be in before that wave comes, you're in a great place to just refinance and sit back and watch your equity go up as everybody goes and starts bidding up homes. For those of people that are in that position, already own a home, I think there's going to be a really good run. And if we were at 6% last year and we had rates touch 8% and we ended the year with the interest rates higher than we started the year, what do you think it looks like in that market when rates get down into the low sixes eventually, if not this year, the following? But again, you've got more times on market right now. That tells me buyers have opportunity. And there's opportunity in every market. Pick what it is. Opportunity in this market is you're going to get a better deal than what you will in another. It is, I wouldn't say
sub
it's
six
fully a buyer's market because it depends on what part of San Diego you're in or what part of town that you're looking to buy in. Some pockets just they're a bit more insulated than others. The opportunity to buy now, you will at least get a better deal on the home than what you will when rates are 1.5% lower in the future.
When in doubt, worst case scenario, you buy now, interest rates go down, you refinance. If not, your home's still appreciating, you got it good to go. The other decision, you wait for rates to go down, that same price, that same home could potentially go up even more than 12% next year. And at $1 million, that's $100,000 more than $100,000 more a month, or excuse me, $100,000 more, which is what, $700 more a month than mortgage?
Yeah, it's about $6 to $7 for every $1,000 you finance. So yeah.
And all for what? That you could have waited, that you could have bought, and you just waited. So the cost of waiting, I'm going to do a deep dive into like the numbers so people can see it, and just because I don't think people wrap their mind around it. Like they think, oh, once it gets to 3%, my mortgage is going to be cheaper. But yeah, you're not going to be able to get it. Like, it's just going to be spending $200,000 more. Like, it doesn't make sense. So finding a way that we can articulate that so people can wrap their mind and like really see it. Not no knee deep lender talk, no accounting, like third grade. But yeah, man, I think I'm late to change my tires. I screwed up. I think B's calling me.
I've got to be on we got the
excellence.
The owner of the core, Mr. Rick Ruby. He does a weekly or monthly call that we all get to jump on and with a top producer. So I'm going to be hopping on there, getting some more knowledge for everybody.
So yeah, pass it on for next week. But if you guys want to get in touch with Jason, all of the links are below. His little website, his loan application process, his number, social security number, his firstborn, anything you need from Jason.
My birthday is coming up, so please feel to send presents and show love.
Nothing but Raiders gear to this man's address. Nothing but Raiders gear.
Please. Geno Smith is not the answer.
And as always, my home buying course is linked below, which helps. It all is the same stuff that me and Jason are talking to you about. Just some people like to read, and it puts it in your email inbox, and you can have it, justify it, go back to it. But yeah, that's all I got, brother. Appreciate you, and I'll see you
Thank you,
again
man.
next week.
That's good seeing you.